The share of trading done by computers has risen the last couple of years. Björn Sibbern, can you explain what computer-generated trading is?
I think first of all it's important to remember that most of our trading is actually done by manual banks and brokers, traders who enters order via their computer. Then we see traditional banks and brokers who uses simple algos when they want to enter orders that are supposed to be traded during the day or following a certain pattern. And then we see high-frequency firms that uses computers, algorithms to do trading, arbitrage between the primary exchange and other marketplaces. So that is the new trend what we have seen.
How does this affect other trading members on the exchange?
Not so much directly. We see much more orders than we normally do, and there's maybe also some extra noise. But the direct impact is not so big. What we have actually seen is that the spread has come down because high-frequency firms has a tendency to narrow the spread.
If we look back, last year saw a flash crash in the US that computers in large part were blamed for. What did you learn from that incident?
I think it's important to stress that the US market is different from the Nordic markets. But what we implemented in the Nordics was something called volatility guards. Volatility guards is an automated circuit breaker where we stop trading if the share price deviates too much from the opening price or the price we have now right here. So after a short break, we open up the market in that share again with an auction, short auction, and we also give the investors a chance during the auction to look at the share price to see if it's traded at the right level.
And the private investors, how are they affected by the increase of the high frequency trading?
Directly, they are not affected that much. What we have actually experienced is that high frequency firms try to narrow the spread. So you could actually argue that retail investors are getting better prices when they want to trade. It's also important to remember that high frequency firms trade very short term, and private investors have a tendency to buy their shares and hold them for quite a long time.